Tom Lee, Stock Market Prediction, for the next 8 weeks, the stock market, urgent. Before we dive into the Tom Lee stock market prediction, it is important to understand how the stock market ends up crashing. So, in this video, I'll break down the main reasons why the stock market crashes and 2 ways to prepare for a stock market crash, and then I will show you Tom Lee stock market prediction, for the next 8 weeks. Now let's dive in. Crashes typically occur under conditions such as a prolonged bull market with rising stock prices and heightened economic optimism, elevated price-to-earnings ratios above long-term averages, and widespread use of margin debt and leverage among investors. A stock market crash lacks a precise numerical definition, but it typically refers to declines of over 10% in a stock market index within a few days. Crashes are characterized by panic selling and sudden, sharp price drops, distinguishing them from bear markets, which are extended periods of declining prices lasting months or years. While crashes can occur during bear markets, they do not always coincide. For instance, Black Monday in 1987 did not lead to a bear market, and the collapse of Japan's asset price bubble happened gradually without distinct crashes. Stock market crashes are relatively rare events. There's a lot to cover, so I'll keep this intro brief, but stay tuned because, in the end, I will give you the priceless Tom Lee stock market prediction for the next 8 weeks. Also, if you find this content valuable, please hit the like button. It costs nothing but helps our channel tremendously. Here are the 5 stock market crash characteristics. 1. A stock market crash is characterized by a rapid and steep decline in stock prices, often following a period of market uptrend. 2. Stock market crashes are typically identifiable only in hindsight, with notable examples including the crashes of 1929 and 2008. 3. Conducting thorough research and diversifying your investment portfolio can help increase its resilience during a market crash. 4. Market crashes can present opportunities to buy stocks at lower prices or to execute a Roth IRA conversion. 5. Consulting with a financial advisor can also help you prepare for potential market downturns. Now let's go over 2 ways to prepare for a market crash. It's important to remember that selling investments during a downturn solidifies your losses. For example, during the February 2020 market crash, a $1,000 investment in an ETF tracking the S&P 500 would have dropped by over 30%. If you had sold at that low point, you would have locked in your losses, but holding on would have allowed you to recover by August of that same year. Re-entering the market later, during more stable conditions, usually means paying higher prices and missing out on the rebound gains. Here are the 2 ways to prepare for a stock market crash. Number 1. Focus on the long term and conduct thorough fundamental analysis before buying stocks. When the market declines, it's natural to feel uneasy as you watch your portfolio's value decrease. However, if you're investing for the long term, sometimes the best action is to stay the course. Ideally, you would have assessed your risk tolerance before investing, understanding how much volatility you can handle in exchange for potential returns. Long-term investing requires enduring the market's ups and downs while staying invested for eventual recovery, which historically has always followed downturns. If you skipped evaluating your risk tolerance or aligning your investments with your temperament, you might be tempted to sell at the worst time, locking in losses that could have turned into significant profits. Your reactions during market turmoil will reflect how well you research the stocks you hold. Remember, your judgment can be swayed by recent market activity, so thoroughly studying the sector and the company can help prevent mistakes during a crash. Number 2. Consider buying the dip. Market downturns can present buying opportunities, allowing you to purchase stocks at discounted prices. To take advantage of this, it's crucial to be financially prepared and willing to invest when prices drop. You might be ready to buy the dip if you have an emergency fund, retirement savings are on track, and you have cash set aside for everyday expenses. By keeping a list of stocks you're interested in, you can act quickly when prices fall. Watching your portfolio decline can be uncomfortable, but making strategic moves for your future self can ease that discomfort. Financial advisors often highlight that market downturns can be ideal for Roth IRA conversions. Converting depreciated assets from a traditional IRA to a Roth IRA during a market dip allows you to benefit from tax-free growth as the market recovers. However, Roth conversions aren't suitable for everyone. They can trigger additional taxes since the conversion counts as ordinary income. Consulting a tax professional can help you determine if this strategy makes sense for your financial situation. Now let's dive into the best Stock market prediction by Tom Lee, one of the top stock market's optimistic investors. And don't forget to smash the like button, it costs nothing but helps our channel tremendously. So, what has Tom Lee predicted for the stock market for the next 8 weeks? Even though Tom Lee of Fundstrat is one of the top stock market's optimistic investors, he warned that the market could decline by 7% to 10% in the coming weeks, advising investors to brace for heightened volatility. "I think investors should be cautious for the next 8 weeks, said Lee. The market has been up 7 of the 8 months this year, showing incredible strength. But September rate cuts and the upcoming election could trigger nervousness. Analysts have also noted that deeper rate cuts might unsettle the market. Bank of America indicated that a 50 basis point cut by the Fed would likely signal heightened recession risks. Friday's jobs report will play a key role in the Fed's upcoming decision, with concerns on Wall Street that the data might fall short of expectations. However, Lee noted that even a strong report could lead to a market pullback as investors adjust their interest rate outlooks. If the data is too strong and the market drops, I would be buying that dip, Lee told CNBC. Lee's 2024 market predictions have been largely accurate, with the S&P 500 up 18% year to date. Election uncertainty may weigh on investor sentiment until results are known, with seasonal volatility potentially extending into mid-October. Liz Young from Sophie mentioned that a relief rally could occur once a president is elected. Lee also sees potential buying opportunities in the upcoming market turbulence, advising investors to remain cautious but prepared to buy on dips, and he also said, "I think the next 8 weeks will offer a chance to buy." Thanks for watching, good luck and good profit. Edward Cash Trader, please read the disclaimer in the description below. You can support the channel by subscribing and turning on notifications. Let's grow the channel together.